Are you an NRI who has recently received an advisory from the Income Tax Department? If so, you're not alone. The department has been issuing advisories to non-resident Indians, particularly those with foreign currency non-resident and non-resident external/non-resident ordinary deposits. This move is a reaction to high-value transactions conducted during the financial year of 2022 to 2023 and instances of non-filing of returns. These advisories are essentially early notifications, a reminder of the wealth of data at the tax department's disposal. They're urging NRIs to validate these transactions, correct any errors, and file any missed returns. Ignoring these reminders or failing to respond appropriately could lead to formal assessments or even reassessments. So it's crucial to pay attention to these notifications, respond promptly, and ensure your tax affairs are in order. In the face of these advisories, it's vital to understand what could trigger such communications. So what could trigger these advisories from the Income Tax Department? Various scenarios could set off these reminders. For instance, depositing funds from overseas earnings, conducting property transactions, or encountering issues with duplicate entries in Form 26AS. Another factor could be neglecting to convert resident bank accounts into non-resident ones. Also, tax complications can arise when tax deducted at source, or TDS, is deducted at a resident rate rather than the higher non-resident Indian rate. Understanding these triggers is the first step, but there are several challenges that NRIs face in dealing with these advisories. What are the challenges that NRIs face in dealing with these advisories? The primary hurdle is the verification of deposit amounts across different banks, especially when FCNR deposits are reported in Indian rupees to the Central Board of Direct Taxes. This process is laborious and often confusing due to the complexity of the reporting mechanism. Furthermore, NRIs are expected to respond to these advisories through the IT portal. However, the portal's design presents its own set of challenges. It only offers drop-down options, leaving no room for detailed explanations, which can be frustrating for NRIs dealing with intricate deposit structures. Despite these challenges, there are remedial measures that NRIs can take. What can NRIs do to address these discrepancies? For those caught in this web of taxation complexities, there are remedial measures available. Filing revised or belated returns by December 31st, 2023 can be a viable strategy. This not only resolves any mismatches in reported income, but also provides an opportunity to rectify any filings missed for the financial year 2022 to 2023. It's crucial to remember that these steps are not merely reactionary measures, but proactive steps towards financial transparency. Addressing these advisories proactively and transparently can help NRIs avoid extensive assessments and stay compliant with the evolving taxation landscape. After all, when it comes to taxation, prevention is certainly better than cure.